Trying to find that next big growth stock. It can feel like you're searching for a needle in a haystack, right? But what if you had a system, a checklist you could use every single time? Well, that's exactly what we're going to build today, step by step. So let's get right into it.
I mean, who doesn't dream of getting in on the ground floor of a company that's just about to explode? It's the ultimate goal. But look, a good story and a lot of buzz, that's just not enough. You need a solid, repeatable framework to tell the difference between hype and real lasting potential. And that's exactly what we're going to build right now.
Okay, first things first, let's get on the same page. Not all stocks play the same game. You've got your income stocks, they're like the reliable workhorses, paying out steady dividends. Then you have value stocks, which are all about hunting for bargains, finding companies trading for less than they're really worth. But growth stocks, they're the sprinters. They're a completely different animal. These are companies laser-focused on one thing, expansion. They take every penny of profit and pump it right back into the business to get bigger, faster.
So here's the game plan for today. We're going to start with what a growth stock actually is. Then we'll build our main checklist. From there, we'll break down the key numbers you have to know, look at what makes a company truly great, and finally, wrap it all up by figuring out how this all fits into your portfolio.
All right, let's start with the basics, the foundation. When we talk about finding a growth stock, what does that actually mean? What are we looking for?
And this is really the heart of it. We're talking about companies that are expected to grow way faster than the market average. And the big telltale sign? They're not sending you dividend checks. Nope. They're taking every single dollar they make and plowing it right back into the business, hiring, building, innovating. They are betting big on themselves, and when you invest, you're betting right alongside them.
Okay, so now that we know what we're looking for, we need a system, right? A repeatable process we can use to sift through the thousands of companies out there. That's where our checklist comes in. This is going to be our framework for finding those potential winners.
It all boils down to a 4-step process. Super simple. Step 1. Is the company actually growing and, profitable? Step 2. Is the market catching on? That's momentum. Step 3. Is the business financially sound? We've got to check the fundamentals. And finally, step 4. Even if it's an amazing company, is the price fair? That's valuation.
All right, time to roll up our sleeves and get into the nitty-gritty. The checklist is our map, but to actually read it, you need to understand a few key numbers. Don't worry, we're going to make these super clear and simple.
First up is an absolute powerhouse metric, return on capital employed, or ROCE for short. Seriously, think of this as a report card for the management team. For every single dollar the company has to work with, whether it's from investors like you or from loans, how good are they at turning it into profit? It's the ultimate test. Can they turn $1 into more dollars efficiently?
And here's our first hard and fast number for the checklist. We're looking for an ROCE above 8%. So why 8%? Well, you can think of that as the company's basic cost of doing business, what it costs them to get the money they need to operate. If they can't earn a return higher than that, they're not really creating any new value. We want companies that are just blowing past that number.
Okay, next on the list is probably the most famous one of all, the PE ratio. All this does is compare the company's stock price to its earnings. Now here's the catch with growth stocks. A high PE isn't always a bad thing. In fact, it's usually the opposite. It's a sign that other investors are so excited about the future that they're willing to pay a premium today for the growth they expect tomorrow. But, and this is a big but, context is everything here. A PE of, say, 40 might be totally normal for a hot tech company, but it would be insane for a slow and steady utility company. That's why you can't look at it in a vacuum. The golden rule is to compare a stock's PE to its peers, to its direct competitors. Just for a frame of reference, the average PE for the entire market usually hovers somewhere between 20 and 25.
So what if we could take the PE ratio and kind of level it up, make it even more useful? Well, we can. That's exactly what the PEG ratio does. It takes that P number and puts it into perspective by comparing it to how fast the company's earnings are actually growing. It's a genius move, because it gives you a much fuller picture of whether you're paying a fair price for that growth.
And bam! This gives us another killer number for our checklist. A PEG ratio under 1 is typically seen as a good deal. It means the stock might be undervalued. So, for our purposes, if we aim for a PEG of 1.2 or less, we're hunting for that sweet spot. Companies with fantastic growth potential that aren't yet outrageously expensive.
Okay, to finish up our financial health check, we've got a few more quick things to look at. First, the Piotrowski F-score. Just think of it as a financial health score out of 9. The higher, the better. Then, for debt, we'll check something called net gearing, We want this to be under 50%, which tells us the company isn't drowning in debt. And last, for momentum, we're looking for a simple visual cue, when the stock's short-term price average crosses above its long-term average. It's a classic sign that the stock is gaining steam.
Numbers are crucial, for sure, but they don't tell the whole story, not even close. The really legendary growth companies have something more, something you can't find on a balance sheet. So let's talk about how to spot the quality of the business itself.
So what are we looking for? First, a real competitive advantage, what some people call an economic moat, something that keeps rivals at bay. Second, you want to see strong, experienced managers who have their own money invested. Skin in the game. It also really helps if the company can grow without needing tons and tons of cash. And finally, you don't want a company that could collapse if it lost just one big customer. And that's why that moat idea is so powerful. Think about it. A super strong brand, a patent on some unique tech. It's like building a castle wall around your business. It protects your profits and keeps the competition out. That's what makes long-term, sustainable growth possible. Okay, we've got our checklist. We know the metrics to look for. So what's the final piece of the puzzle? How do you actually take all this information and use it to build a smart, solid portfolio? The number one rule, the most important principle of all, is diversification. You've heard it a million times. Don't put all your eggs in one basket. It's that simple. By spreading your investments across different companies and industries, you're building a safety net in case one area takes a hit. So the natural question is, how many stocks is enough? Is there a magic number? Well, a lot of research points to a sweet spot. Once you own around 25 to 30 different stocks, you've pretty much eliminated most of the risk tied to any single company. This way, you get the upside of the whole portfolio without sweating what happens to just one of your picks. And one last, super important thing to remember. This is not a set-it-and-forget-it deal. Investing is an ongoing process. The world changes, a new competitor could pop up, or the company's strategy might shift. Being a successful investor means you have to stay engaged, to check in on your investments every now and then, and just make sure the story you originally bought into is still true. So there you have it, a complete framework, a step-by-step checklist for finding great growth stocks. From digging into the numbers to building your portfolio. You now have the tools you need to look past the hype and really see a company's true potential. The only question left is, what future are you going to invest in?